Hello, everyone. Thank you for joining today's webinar on money management with Brenda Lynch, CPA. Before we begin, I want to let you know that Allison James Estates and Homes is a nationwide brokerage which offers 100% commission, 100% support, and 0 franchise fees. Why split your commission if you don't need to? You earned it all, so shouldn't you keep it all? Our goal at Allison James is to always give back to our agents by providing education, training sessions, live webinars, live events, and full broker support with the most up-to-date tools and technology available. We are always looking for new tools and ways to be able to provide them to our agents at a lower or discounted price so you can keep all of your hard-earned money. Today's webinar is sponsored by Movement Mortgage, which happens to be our preferred lender. And for more information about Allison James Estates and Homes, please visit us at www.ajicareers.com. So let's go ahead and get started with today's topic. If you have any questions throughout today's presentation, please submit your questions into the chat box on your Zoom control panel. I will now pass it over to our speaker for today, Brenda Lynch. Good morning, Brenda.
Good morning. You have to bear with me for just a moment. I am a little new to this screen sharing, so let me see if I can get my PowerPoint presentation up here on my screen. See that? Here. That's it. Can you see my screen now?
Yes, I can.
Okay. All right. Just trying to get it. All right. So my topic for today is money management for real estate agents. Just a little background for me. I'm with a firm called Olson Lynch and Associates, certified public accountants. I have been in the accounting field since 1989. I graduated, and about 11 years later, I got my CPA designation and have been working in public accounting ever since, primarily doing tax and accounting services for small business and personal. So that's a little bit about me. All right, so in the real estate profession, as most of you know, you are not employees anymore. You are independent contractors. So unlike a traditional job where your employer deducts the federal tax, Social Security, and Medicare tax and sends it over to the IRS, real estate agents earn commissions and are considered self-employed. The upside to this is that as a self-employed agent, you're able to deduct ordinary and necessary business expenses from your gross commission. That includes desk fees, rent, marketing fees, meals with clients, auto expenses, cell phones, things like that, things you wouldn't be able to deduct as an employee. The IRS a few years ago took away employee business expenses as an itemized deduction. So it wouldn't help you to be an employee because you'd lose all of those deductions. So the downside of being an independent contractor is that come tax time, without managing your cash flow, you could be faced with a potentially large tax bill if you don't plan and prepare properly. Depending on what your commissions are for the year, you could have a pretty big tax bill, but as you earn those commissions, you're going to understand that more earnings, more tax. But there are things we can do to minimize that tax and to help you manage your money a little bit. So the first thing that I want to talk about is independent contractor options. So an independent contractor can be one of several different types of entities. The first one is a Schedule C. That is basically you report all your income and all your expenses on your personal tax return on something called a Schedule C. And that is a business, basically a business form that basically it's not a legal entity. And 100% of your profits are taxed for federal income tax purposes, but it's also taxed for self-employment purposes. So you have Social Security and Medicare tax on top of your regular income tax. So Social Security and Medicare is 15.3% total tax. So you can see that that is the employer side of the Social Security and Medicare of 7.65% plus the employee side. So usually as an employee, you pay 7.65%. As an independent contractor, you pay both sides of it, and that's 15.3%. The next type of entity is a corporation. Corporation requires registration in the state you're doing business in. And I don't know about other states, but in Florida, the Florida Board of Realtors, basically they say if you're an independent real estate agent, you have to be registered as a PA, which is a professional association. You have to use your professional name. So like Joe Smith, PA would be, a good example. Basically saying that you're Joe Smith doing business as a professional association. The best option as a corporation is to make an S election. That taxes the entity as an S corporation. The benefit to this is that you as the owner must take a reasonable salary throughout the year. The owner becomes an employee of the corporation and is subject to withholding. The good side of that is any additional profits at tax time are taxed for income tax. However, they are not subject to self-employment taxes. That 15%, 15.3% I was talking about under the Schedule C. Basically, so if you made $100,000 in net profit from your corporation and you paid yourself $65,000, the additional $35,000 would flow through the corporation and only be taxed for federal income tax. It wouldn't be taxed for that self-employment tax, the 15.3%. So it gives you a little bit of flexibility as to how much you're going to be taxed for the self-employment taxes. And it could save quite a bit of money depending on how much commission is earned for that year. So, and then the third type of entity as an independent contractor is a partnership. Most of the time, that type of entity would be, I'm sure you've all heard the term LLC, limited liability company. You actually have to have more than one owner to be considered a partnership. So unless there are multiple owners, this is really not a valid entity for a real estate professional. So we don't really need to talk about that much. So I'm going to go back to this one. So you can see, depending on how you set up your entity, that's the first decision that you need to make as far as tax savings and money management. Most of the time when I see realtors come to my office, they're either set up as a Schedule C or an S corporation. I do recommend the S corporation because you have that flexibility of taking your salary. The biggest thing on that is you must take a reasonable salary. So if you make $100,000 in commission and you take $5,000 in salary, you can see that that's not going to be a reasonable salary. What the IRS can do is they can come back and they can say, okay, you didn't take a reasonable salary. So instead of just saying, okay, here's a reasonable salary, basically they have the ability to go back and say, nope, all the $100,000 that you earned that year is now going to be reclassed as salary. And you're going to owe that 15.3% on 100% of that salary. So you really want to make sure that you take that term reasonable salary into consideration when setting a salary. And you can adjust your salary during the year based on, what your commissions are. If you're not making as much as you thought you were, you can reduce that salary. And same thing, if you're making a lot more than you thought you were, then you can always raise that. So the next part of money management, it really requires careful planning and budgeting, because the real estate profession is very unpredictable based on when and how much is earned. Right now, it's a pretty hot market out there, most places. And, you're probably, if you've been in the business for a while, you're probably established, and the commissions are coming in pretty regularly. However, in the regular market times, it's important that you plan not only based on when your commissions are going to come in, but you have that tax liability at the end of the year that you always have to be thinking about. I see all the time people earning commissions, and even with the planning that we do with the salary and all that, they end up at the end of the year owing thousands of dollars, and they haven't planned. They haven't set aside the money to pay the taxes, and they're really in a bad situation when tax time comes and you have to either set up a payment plan with the IRS or try and fund that tax liability. The IRS is the highest source of funding you can get. You're much better off, if you owe money to the IRS, you're much better off either getting a home equity line of credit or something with a lower rate to pay that IRS tax liability. So as your commission is earned, I highly recommend you set aside a certain percentage of your commission for that tax liability. Usually I recommend 20%. 20% of the commission. You're also going to have those expenses against your commission. So when you average it out, 20% comes out to a reasonable amount to set aside. And obviously, depending on how much you're earning, if you're in the very high income brackets, you might want to do a little bit more. And if you're not doing real estate full-time, you might want to cut that back to maybe 15%. So the other thing is, many agents that have been in the business are probably already paying quarterly estimated taxes to the IRS based on prior year tax liability. That's because the IRS has regulations on what type of estimated payments you have to pay in when you have a tax liability for the prior year. So we always estimate those taxes for the following year based on the year before, so that you don't get penalties and interest. So because of the nature of the real estate profession, you have to remember that your commission is not a regular weekly or monthly guarantee payment. Budgeting is really important. I recommend that you plan an annual budget. What do you need to make to cover your personal expenses and stick to that budget. If your commissions are behind based on your budget, then you need to make adjustments to your spending, your personal spending. If you can't make adjustments, then, I always recommend that you have a fund set aside that will carry you through those down times. So I always call your other partner. You always have another partner in your business. It's called the IRS. Everything we've talked about is basically what can we do to minimize your tax liability. So that's your biggest expense. You figure if you're paying 20 to 25% to the IRS, what other expense is going to be bigger than that? Most likely that's going to be your biggest expense of your business. So we want to minimize those taxes. One good way is retirement planning. Depending on which type of entity you've selected, contributions to retirement accounts can significantly reduce tax liabilities. That's because they're upping the limits on how much you can contribute to these plans. Most entities are eligible to contribute to what's called a SEP. It's a simplified employee pension account. Limits on that depend on income, whether the entity has any other employees, and the type of plan. The biggest one that I see is if you have other employees in your corporation or in your sole proprietorship. Other employees would be like if you have an assistant that you have on the payroll. The reason that's important is because the IRS looks at retirement plans as you have to do for all what you do for one. So you can't just have a retirement plan with you on that plan. You have to offer it to any employees that are in your company. So you always got to look at that. The other thing is expense tracking. You need to make sure that you capture all of the expenses that you're entitled to. I talked about some different ones earlier. Things like if you use the internet at home for business use, most likely you can deduct some, if not all of those expenses that you incur. If you're using the internet for business, if you have a home office set up, all those things, capture those expenses, make sure, because you got to figure for every dollar that you capture for business, it's 20 to 25% savings. And that goes for that retirement planning also. If you put $1,000 in a retirement plan, 200 of those dollars are going to be tax savings. And that money goes directly to you because you're putting in an account for your retirement. So back to the expenses, auto expenses. You have the ability to choose mileage versus actual expenses. That's for a Schedule C, for a sole proprietorship. Now, as a corporation, you're not allowed to take mileage. However, you are able to reimburse yourself mileage. And that would be taking the IRS standard rate times the number of miles and actually reimbursing yourself for that expense. And that can add up to a lot. The other thing you can do is you can take actual expenses, but you have to be careful. You can't switch between the two methods with the same vehicle each year. You have to pick a method and you have to stick with it. The other thing with mileage is you really need to track your miles regardless of which method you used. in my experience, when an IRS auditor comes in, the first thing they ask for is a mileage log. If you've taken auto expenses, they ask for that mileage log, regardless of which of the two methods you use. So if you don't have that mileage log, they're going to ding you. They're going to take away that expense, and that can be a lot of money sitting on the table. Cell phones, new rules eliminated the need to allocate between personal and business use. Personal use is now considered de minimis. So basically what that means is if you have a cell phone and you use that cell phone for business, you get to deduct 100% of that cell phone bill. Now, just remember that's for your cell phone bill and anybody else that you pay for that works in your business. So you can't just take your whole cell phone bill if you've got, your 3 kids and your husband on the plan. You have to, you can take your cell phone, but you don't have to allocate between the personal and business use anymore. And then meals, document who you're paying for meals and the business purpose. Usually I say a good idea is to write on the back of the receipt or in your appointment book, what was the purpose and who did you take out? The biggest thing for 2021 and 22 is that meals are 100% deductible as compared to 50% deductible in other years. That was part of the stimulus plan for 21 and 22. I don't know if any of you realize that 2021 was 100%, but when you get your 2021 tax return prepared this year, you'll see that the meals should be 100% deductible. And then going forward to 2022, they should be deductible also as at 100%. So these are just kind of a few of the expense items to make sure you're capturing pretty much as you're going through the year. If you incur an expense, think about it. Even if you're not planning on writing it off, think about it and think about, could this be a business expense? It has to be reasonable. It has to be customary that, in the real estate business or the real estate profession, is this a typical expense? Always think about advertising, your marketing, your signage, those are pretty much given that they would be business expenses. However, those off the wall things that, you wouldn't even think to deduct, think about them. Always be thinking about what could I deduct? Because it's really, if you're audited, it's up to the agent that audits you on whether or not you lose that expense or not. So they have to audit you to take that away. So as I said, your biggest partner is the IRS. We always want to do things to minimize that liability with them, and basically starts from day one, from your entity selection to the miles that you use with your vehicle. So that's about all I have. Thank you very much for listening, and if you have any questions, let me know.
And thank you, Brenda. We did have a couple of questions come through the presentation. So Sabrina is asking, is there a guideline for a reasonable salary, as you had mentioned in the beginning?
So there really isn't a guideline, and I get that question all the time. You just have to think about what would a normal person get paid for what they're doing? So sometimes you know, an example would be a doctor, you know, who's got an S corporation and they're paying themselves a salary. I actually had a doctor that I got as a new client. He was being audited by the IRS, and his accountant at the time set his salary at $5,000. Everything else flowed through without that self-employment tax, or without the employment tax. That's not reasonable, obviously. So we agreed with the agent that 150,000 would be much more reasonable for him. And ever since we've been using that 150, he had quite a bit more income going through his company than just that 150. So he's still saving money. He's not paying the self-employment tax on everything, but it has to be reasonable. So if you're making a lot of money in commissions, you know, you just need to think, you know, I would say if you're up in the 200 or 300 range, you want to be at least 100,000 as on salary. You know, but is there a typical guideline? No, there's not. And I think that the IRS has not set that guideline because they want to have a little bit more control when they go into an audit and look at what you're paying. I know that's not really a great answer, but that's what I got.
Well, thank you for that answer. Next question we have is from Lindsay. She states that her tax person had told her that she cannot claim her home office because it does not have an outdoor or an outside door access. Can you shed any light on that?
Yes and no. No, it doesn't have to have an outside door. So the rules for a home office, if you're using your home as an office, but you have another office, like if you have a main office that you go to check into work, and, you know, let's say there's you know, a current, you know, an actual physical location that you go to every day or however many times a week, whatever, then home office is not allowed. And the reason for that is it's not your primary place of doing business. So your home office has to be the primary place that you do business. You can't have multiple locations. The outside access really doesn't come into play. That's, you know, as a realtor, you usually don't have your clients coming to your office per se. You're usually out showing your clients the listings and everything. So I don't think that argument is correct, but that's my opinion.
Okay, and she did follow up as you were clarifying. She just stated that no main office, just her home. So maybe she should look into further clarification from her accountant. All right.
Yes, I would absolutely.
Now, next up, Rosie has a question. She asks, is it true that it is best to ask for an extension rather than pay by 4/17? She also had a couple follow-up questions, so I don't know if you want to address that one first.
My answer to that is no. It's not better to ask for an extension. I have not, you know, and this has been a topic that's come up before in conversations with my staff. It doesn't, I mean, the IRS has so many returns that they're processing. It does not make a difference if you file for an extension or not,
Okay.
in
Now,
my experience.
one of our follow-up questions is regarding mileage. Last year, I did not get a mileage log. How can I do it? How can I do to deduct my mileage for 2021? I did it for this year, though.
So if you don't have a mileage log, use a calendar. A calendar is really easy because you usually mark your appointments on there. And so you know where you've been. And so just take the mileage and put it right there in your calendar. You don't have to have, I mean, a log can be a lot of different things. It can be, you know, it doesn't have to be a specific format. All you want to do is, you know, one thing I do recommend is take your mileage, go get an oil changed sometime at the very beginning of the year and sometime at the very end of the year. And that basically tells you how many miles you drove in that particular year. And then your mileage log should correspond to that many miles. So you can't have driven your vehicle 10,000 miles and had, you know, 15,000 miles in your mileage log. There's, you know, so that's one thing the IRS looks at.
All right. Now,
And they're the ones that recommended that oil change thing or something to document the miles.
Okay, and in touching base on that, we had an anonymous attendee did ask, or stated rather, I recommend Mile IQ for mileage tracking. Have you ever heard of the Mile IQ?
There's a lot of apps out there.
Okay.
And I haven't used any of them at this point. But I know there's a lot of them that are really good. I think there's some that you can just, you know, click on it. It'll start tracking miles. And when you get to your destination, you just click on it again and it'll just record them. So yeah, whatever makes it easy for you.
All right. And then we have one last question from her, and then we have a few other questions from other attendees. But her last question is it better to buy a car on a lease rather than buy a car? Is the car, if we buy it, has to be of a certain weight?
Okay, there's a couple of different questions there.
There are. I'm just reading the question.
Yeah, I know. For me, myself, and my preference, I always buy cars. Part of the reason is I don't put that many miles on, and I tend to keep my cars for a long period of time. That's going to be different for everybody. So if you're driving a lot of miles, which realtors tend to do, you know, as long as you stay under your lease miles, you know, you might be better off. And if you tended to trade in cars, like every 3 to 4 years, then leasing could be better for you. The downside of leasing is that, you know, you pay for that lease payment for a certain period of time. And at the end of that time, you don't have anything. You don't have an asset that, you know, when you buy it, you can finance it for a specific period of time. And at the end of that finance period, you have an asset, it's yours. And then you can either sell it or you can continue using it. So it's kind of a personal preference, but, you know, but based on usage and your tendencies as far as keeping vehicles, or, you know, and realtors have to have, you know, some realtors have to have a standard of a vehicle that's, you know, that's newer, depending on the type of clientele that they're dealing with.
Okay. And then a certain weight, or be of a certain weight?
So the weight category is based on whether you can write that. That would be more of a purchase category. because the weight is dependent on whether or not you can write off 100% the first year, 25,000 the first year, or just the standard vehicle amount the first year. So a regular vehicle has limits. If you have a small SUV, or then there's the availability to write off 25,000 the first year. And then if you go over, I believe it's I'm not even gonna say what the limit is, but if you go over a certain limit as far as weight, then you can, if it's a large SUV or things like that, then you can write off 100%.
Okay. Now, a quick follow-up to that question. I have another agent asking two questions, but one goes hand in hand with the topic. What can you use to write off on the car? Is it just mileage?
So that's where you have the choice of either mileage or actual expenses. And usually you have to pick a method and you have to stick with that method. So if you choose mileage, you go by the IRS standard rate. If you choose, and that's per mile. If you choose to do actual expenses, then you basically can write off the lease payment, the interest, if you lease it, the interest if you purchase it and you finance it, the depreciation if you purchase it. And that's where the 25,000, and all that comes in.
Okay.
Go ahead.
Well, I was going to just follow up with the same agent that's asking another question about, in the state of California, do we need a business license?
In general, you need to have, and I don't know California's rules, but in general, you need to have, obviously your real estate license. I would assume California requires a real estate license. And then if you're a sole proprietor, you probably don't need to have a business license, although I'm making certain assumptions. There may be licenses like based on your local authorities that say, okay, even if you're not a corporation, you still need to have the local licenses. So I'm just going by here in Florida. We live in a place called Punta Gorda, and Punta Gorda has licenses that you have to have, and then our county has licenses, and then the state has licenses. So it's not, that's a hard question to answer without knowing the locality.
Okay.
But as a sole proprietor, you're going to need less and less licenses and things like that, because you're not registered as an actual corporation or.
All right. And we have a follow-up to that topic as well. When is it necessary to switch from sole proprietor to S-Corp?
That's going to depend on your business, your cash flow. If you're just starting out and you don't know if you're going to be in the business and you're just kind of trying it out, you could probably start as as a sole proprietor. Once you start having profits, larger profits, you gotta draw that line. So if you're gonna take a salary of, let's say, 50,000 anyway, and your profits from a sole proprietor are only 40 after all your expenses, then you may not need to switch to an S-Corp. It's where you get up to where a reasonable salary is outweighing the amount of profits. And if you take a reasonable salary and then let the rest of it flow through, you have a savings there. Because there's no sense taking a $50,000 salary and having a loss on an S-Corp. Because then you're kind of upside down on that and you're paying tax that you really don't need to pay.
Okay.
Does that make sense?
Yeah, Lisa, did that answer your question? If so, just type in the chat box. And while we're waiting for Lisa's answer, I do have one last question from another agent stating that I'm using my stuff to for staging my listings. How can I deduct? Please advise.
When you say your stuff, I'm assuming that you mean like you've purchased furniture and accessories and things that you're using to do the staging.
Yeah, that's my
Right.
assumption as well, based on how the question is formatted.
Okay.
So, yep.
If that's the only thing you're using it for, then what I would do is I would go back and look at what you paid for those items and contribute those items to your company. If you're actually going into your house and you're raiding your house and taking your sofas and everything from your house, then that's a different story. But if you're putting this stuff in storage and using them just for staging, then even though it's your stuff to begin with, I would estimate the cost of those items and write them off in your company.
Okay. All right. And Lisa did get back to me and say that, yes, that answered the question. Thank you very much. All the agents that you've answered the question from have thanked you. So I believe that's all we have for today. Unless there's anything else, I'm going to wrap it up now. And thank you, everyone, so much for joining us. A huge thank you to you, Brenda, for hosting this month's webinar and giving us a great presentation. Have a great day, everyone.
Thank you.
Thank you.